Are you feeling overwhelmed by taxes, uncertain about your business finances, or worried about protecting what you already have built? Well, you're not alone, and there's a better way. I'm Ashley Freeman. I'm a tax and asset protection attorney, and this is Tax and Money Mastery, where faith meets financial wisdom. Each week, I'll show you how to legally reduce your taxes, manage your money with clarity, and protect your business and personal assets so that you can focus on what truly matters most: God, family, and career. Proverbs 10:22 says, "The blessing of the Lord makes one rich. He adds no sorrow." So grab your coffee and settle in. This is a podcast you can't afford to miss. Hi, welcome to Tax and Money Mastery. I'm your host, Ashley Freeman. Today we're going to talk about the accountable plan and how it can affect you, how it can benefit you, and how we can pull money out tax-free from your entity. All right, so let's get started. So the accountable plan is something that you're going to use with your C or your S-Corp. Those are the only two things that it works with, corporations. The accountable plan we can utilize to pull money out of our corporations tax-free. We can use the administrative office, mileage, cell phone, internet. So let me go into how exactly we do this. When we have a C or an S Corp, we have to adopt an accountable plan. You can find the paperwork for an accountable plan all over the internet. It's usually just a couple of pages long, and you just basically have to have a meeting and adopt it. Adopt the plan, keep meeting minutes that you adopted the plan, and then it's going to enable you to use the office and other things. So how are we going to figure out now it's called your administrative office. Unlike if you had a Schedule C is on your 1040. Okay, a Schedule C is a home office. Let's go back to the cookie making business. I've got an office set up in my home. I've got one of my bedrooms I'm using as a home office. I can deduct the size of that room. This is on a Schedule C. I can deduct the size of that room and part of my utilities. Okay, great. The accountable plan will enable me to do the exact same thing. I'm going to figure it out the same way. I can either use square footage of the administrative office. I can use square footage minus unusable space, which is going to include hallways, stairwells, bathrooms, closets. We're going to subtract all that square footage off of the main house footage. What that's going to do is it's going to shrink the size of the building, but it's going to increase the size of the office. So that's one way. And there's the square footage. And then the third way is the number of rooms in the house. So if there's 10 rooms in the house and you're using one for an office, then you're using 10%, 1/10. You're going to want to try it all three different ways because I've seen it be much more beneficial one way than the other ways. And it depends on the size of your house, the size of the office, and things like that. You're allowed to use the largest size, whatever works best for you. The IRS doesn't have any specific guidelines. It just says any reasonable means of figuring out how the size of your office. Once we figured out the size, let's say we're using 20% of our home as an office area. You can also include spaces that aren't in the office, that maybe you have a storage room that is specifically things for your business. That square footage can be added on also. All right, so we're using 20%. Now what we're going to do is we're going to add up all of our expenses for the house, the property taxes, the insurance. We can take depreciation on the office portion of the home, gas, electric, water, sewer, trash, all the things. Even if you meet with clients in your home and you have a housekeeper, you can deduct that portion of the housekeeper's pay too. So, as well as lawn services, if you meet with clients or clients come to your house. So let's say we added all those up and they add up to $500 a month. And we're going to be able to take 20% of that. Let's make it easy, $1,000 a month. So we're going to be able to take $200 of that and reimburse ourselves for the use of our administrative office. It doesn't sound like much, but it certainly adds up over the year, especially when you figure in the depreciation. That's huge. To figure out the depreciation, what you're going to do is you're going to take the purchase price of your house plus any major improvements you've put into it over the years, like a pool for $20,000, a roof for $10,000. All that gets added into your basis. Then you're going to take the basis. So let's say the basis is $100,000. is what your basis in the house is. You're going to divide that by 39 years. And the reason we use 39 years is because this is for the administrative office, and the administrative office is considered like commercial. So 39 years is what we depreciate things in the commercial realm. We're going to divide that number by 39, and that's how much you're going to be able to deduct per year or take as depreciation per year. You're going to divide that up if you're doing it monthly, divide it by 12, and that's the amount of depreciation you're going to be able to reimburse yourself every month. So that's your administrative office. Under the accountable plan, you can reimburse yourself for mileage. This year it's 70 cents a mile. Who knows what it'll be next year, but 70 cents a mile really adds up quick. That's a good chunk of money. We usually want to reimburse mileage rather than purchase a vehicle in the business name, just because it's a lot more hassle. It puts everything in your business at risk. If there's an accident, you have to pay twice as much in insurance because you have to get commercial insurance. And then you got to worry about depreciation. So you don't have to do that if you just reimburse yourself using your vehicle, reimburse yourself mileage. You do have to keep a mileage log. There's something called Mile IQ that works really good on your phone, or the old-fashioned paper and pen. That's what I use. The old-fashioned paper and pen sitting next to me, squished between my seat and the console. Works well. Because then I got a paper and pen. If I'm driving by something and I want to write down a phone number or something, I can do that really quick. Cell phone and internet. You can reimburse yourself 100% with the accountable plan. Back when we had the Schedule C instead of a C or an S corporation, we could only deduct the portion of the cell phone and the internet that was used for business. With the C corporation or the S corporation, we get to deduct the entire thing, as well as our spouse. If our spouse is part of the business, doing something in the business, their cell phone can be 100% reimbursed also. The reason the reimbursement is better is you get to put the money in your pocket. You don't just get a deduction at the end of the year. You get to put the money back in your pocket out of the C Corp tax-free. You give the C Corp a copy of the paid bill at the end of the month, along with a reimbursement form. The C Corporation or S cuts you a check. You pocket the money tax-free. That doesn't get reported anywhere. It's totally tax-free. The C Corp, though, on the other hand, gets a deduction for it. Another thing that can also be used by the C and the S Corporation is the 280A rule. It's commonly known as the Augusta rule. The reason it originated in Augusta, Georgia, with the Masters Open. And all these people would come into town. They would fill up the hotels and stuff, and then people there was such a need for more hotel rooms and everything that people started renting out rooms in their house or renting out their whole house. They didn't want to be in the area when the Masters Open came because there was so many people. So they'd rent out their house and they'd go away for a couple weeks. And so that's kind of where it originated from. Somebody had a lot of money and lobbied and was able to get it passed so that the Augusta rule became the 280A rule. 280A is the number in the IRS code. Anyway, so what it is, this can be used with the C and the S Corp. And what it is the IRS allows C corporations and S corporations to have meetings. They have business meetings, training meetings, planning meetings, annual meetings, shareholder meetings, whatever. Corporate Christmas parties even you could do. You can have up to 14 of these per year and reimburse yourself out of the corporation tax-free. So how this one's going to work is you're going to call around to 3 or 4 different hotels in the area, nice hotels that have meeting rooms. Don't let them try and give you a quote for a bedroom. You want a meeting room. And this is going to be a written quote. So it's going to have everything, the appropriate size meeting room. So if it's just you and a spouse, maybe, or you and a couple people, it's going to be the smallest meeting room that they have. You're also going to want everything you would need in that quote for a business meeting, like internet for the day, AV equipment, breakfast, lunch, snacks, coffee, donuts, okay, all that. And then you're going to go somewhere in between those 2 to 3 quotes, and that's what you're going to charge your C or your S Corp every time you have one of those meetings. You can have up to 14 meetings per year. Don't go 15 meetings, because if you do, you just made all that taxable to you, all that income as income. So if you keep it 14 and under, it's tax-free, okay? Make sure you keep meeting minutes and, keep track of them, keep them in a folder, who was there. If there's more than just a couple of you, even if there's a couple, have a sign-in sheet and keep that in your records. That way, if you ever get audited, the IRS is going to see you're treating this like a business. And that's really what they want to see is your paperwork. Is your paperwork in order? And if it is, then they see that you're treating it like a business and they don't have a problem with it. The chance of you getting audited in a C and an S-Corp are so slim compared to a Schedule C that goes onto your 1040. That is like IRS red flags. Boom, 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 all over the place. That's how the 280A rule works. And it's pretty nice because you can, depending on where you live in the country, I've seen it be anywhere from like $600 a meeting to thousands per meeting. So that's all money that's going to go into your pocket tax-free. So you're going to bill your S corporation or your C corporation whenever you have one of those meetings. It's going to cut you a check for that amount and you're going to pocket that money tax-free. It's the same as think of it as if I own the corporation and you work for me. You're an employee. I ask you, hey, pick up donuts, Kenya, on the way to work tomorrow morning because I want to have a little hoo-ha for the sales team. They did a great job. So you pick up the donuts, you give me a copy of the receipt and a reimbursement request form. I cut you a check. You put the check in your pocket. That doesn't get reported. That's not income. I just reimbursed you for something that you did for my corporation. Then I, as the business owner, get a deduction for that because that was something that I needed for my business. But now think of it that you actually own the C corporation and you're also the employee. To be an employee of a C corporation, you do not need to take a salary. You never need to take a salary. You're not required to, but you're still considered an employee. So you get that fringe benefit. That's with a C corp. With an S corp, it's different. You have a salary in an S corp that you must take if you take a distribution. So that's something different, but you still get to do the 280A rule with the S Corp or the C Corp, either way. If this podcast has taught you something or blessed you in some way, please do me a favor and share it with another business owner who may need this information. If you would, please write a review for me. I appreciate it very much. Commit your work to the Lord and your plans will be established. Proverbs 16:3. See you next time.